The following program is being brought to you on the Voice America Business Channel. For more information about our network and to check our additional show hosts and topics of interest, please visit voiceamericabusiness.com. The Voice America Talk Radio Network is the worldwide leader in live Internet talk radio. Visit voiceamerica.com. The views and ideas expressed on the following program are strictly those of the host or guests and do not necessarily reflect the views and ideas held by the Voice America Talk Radio Network, its staff, and management.
Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Your host, my guest this hour is Bill Westrom. He is the president of truthandequity.com, and he specializes in the strategy called mortgage equity optimization. Welcome to the Money Answer Show, Bill.
Hello, Jordan. Thank you very much.
Let's just start with your background and how you got and eventually created truthandequity.com.
All right. I've been in the banking and mortgage finance industry for about a little over 15 years now. And through that, my career, I've worked in the belly of the dragon with some of the biggest banks in the country, WAMU, who's no longer here, some smaller operations. But back in 2002, I was introduced to a very unique mortgage out of Australia by Macquarie Bank. And that's when I first heard about this kind of program. And fortunately, I had the opportunity to work for Macquarie in 2006. They recruited me to join forces with them because they realized I was one of the leading people in the country in regard to this strategy. And so I worked for them for a short while in 2006, but through that job with those folks, I realized there was a huge flaw in how it was being brought to the public. So I put together a plan to get it to the public as opposed through mortgage brokers. And that's what Macquarie was doing, was trying to introduce it to the public via mortgage brokers. And I felt it would be best to get to the public and bypass the middleman. And that's what I did in 2006 when I started truthandequity.com.
So what is the problem with the way people do mortgages today? Most people are very happy. They sign up for their mortgage. They feel they're lucky they got their home. They pay it off. They get mortgage interest deductions. They're getting extremely low interest rates today. What's wrong with that picture?
Well, to be perfectly honest with you, there's not a whole lot wrong with the picture itself from a conventional standpoint. We talk to a lot of people, and most people are running their lives perfectly under a conventional model. Low rates, everything you just described. The problem exists when you start pulling back the layers and seeing the performance of that conventional practice. For example, if we look at the total mortgage debt of our country, and if we use an average rate of about $5,000, well, studies have shown if we look at the total numbers, we're spending about $247 billion a year in mortgage interest alone. And that's a huge chunk of change, and that's just because that's all being derived on a conventional mortgage, the way it's the long-term amortization, the upfront interest costs and such. It's just the way that the system is developed as far as mortgages go.
So you're saying it's worked well for people so far, but there's a better way, is what you're saying.
Yeah, it's just inefficient. It's just, everybody that's got a 30-year mortgage or an amortized loan, they know it's like trudging through wet cement. You'll eventually get to the goal line, but boy, it's a slow process. And what we do, we just introduce a more efficient method of running your personal finances, and it's more of a corporate mentality than a homeowner's, a consumer mentality.
So what do you mean by the corporate mentality? How is an individual supposed to be trading, dealing with his mortgage like a corporation would?
Corporations live and die with the use of a line of credit. They build empires around the line of credit, and they use a line of credit because it's a low interest rate. It's a simple interest calculation, and it's got a revolving door. They can get in and out at their leisure. So when a corporation borrows money to expand their operation, they will self-finance it first and foremost through that line of credit. And once the improvement's been made and the revenue's being generated, they get that revenue filtered back through that line of credit to pay off the debt very quickly. And most banks will do this for corporate accounts through what they call a sweep account, where the bank will actually do it for them and sweep their revenue against a debt. So it's minimizing their interest costs and aiding in the rapid acceleration of the payoff of the debt. And that's what corporations do, but we don't do it as consumers.
So there's two sides to the equation. One is the $247 billion people are paying in mortgage interest. How about on the checking and savings side? Right now, when you put your money into a checking or savings account, you pretty much earn zero, and it looks like it's going to stay that way for a while. What is the loss to consumers in keeping their money in a checking or savings account these days?
The loss is billions of dollars. Now, if we go back to the example I used for the $247 million, if we practice an offset accounting method or a sweep mentality like corporations do, we could save, as a country, we could save $29 billion a month in interest costs alone. If we get that money out of a checking account that's earning zero, having the opportunity to sweep it against the debt, so that income is offsetting that loan's ability to charge us interest, and in the end, the savings is collectively $29 billion a month.
So you're saying that consumers would pay $29 billion less in interest on their mortgages by using the truth and equity optimization system you're talking about.
That's exacther right. Let me give you a real quick story, a quick example of a regular conventional mortgage. I just was working with a customer just yesterday running these numbers, and this is pretty average across the board. This gentleman's been paying on a mortgage for 6 years, and after 6 years, he still owes 90% of what he borrowed, and only 6% of his monthly income is being applied towards the debt. Only 6%. 21% of his income is being applied, monthly that is, 21% is being applied towards interest. Now, I think anybody can do the math and see, well, that's an incredibly imbalanced relationship, and that needs to change. And once that changes through equity optimization, that's where you can get your $29 million in savings.
Now, one thing people would say is, well, mortgage interest is deductible, so I certainly don't want to pay less mortgage interest because I won't get deductions. What's the comeback to that?
Well, mortgage interest that's a funny animal because everybody thinks, boy, that's going to look good on my tax return. But just for example, let's assume that you're spending $10,000 a year in mortgage interest. Well, you don't get to write the $10,000 off your tax bill. That $10,000 is coming off your adjusted gross income. And if we use simple numbers, let's say 30% tax bracket, at the end of the day, your gain, you get to keep $3,000 and not send it to the IRS. Now subtract that from the $10,000 that you spent in mortgage interest. That leaves you $7,000. You spent $7,000 to keep $3,000.
Yet people are enamored of mortgage interest deduction and think this is cutting their taxes. So basically, you're getting a benefit at your tax bracket.
Indeed. You know,
and not more than people think of it 100%. It's if you're at a 25% bracket, you get 25 cents on the dollar, but you still have to pay the other 75 cents. Is what you're saying.
That's right. Now, on the other side of the coin, if you were able to pay off your mortgage and spend or not spend $10,000, keep that $10,000 in your pocket, well, that means at the end of the day, you're going to be sending the government $3,000 because you don't have the write-off. But you kept $7,000 in your pocket. That $7,000 can go a long way as opposed to interest in somebody else's pocket. I'll gladly give up $3,000 every year to maintain $7,000 in my pocket.
So, if you went to a bank and said today, I'd like to start the mortgage equity optimization strategy, what would their reaction typically be?
Well, it could be quite varied, but you're going to probably get the deer in the headlights look because 9 out of 10 bankers are not familiar with that term for sure, and they're definitely not attuned to a sweep offset account mentality for consumers. They're just going to look at you and say, we don't offer that, or you might be in the wrong building.
And do they have an interest in learning about this and offering it? Is it to the benefit of the banks?
Well, they sure do. If they understood it and they understood the ramifications for themselves as well as the consumer, they'd be offering this to everybody that walked through the door. Because you look at these failing banks, and a bank's failing, well, aside from them making bad choices as far as the investments they got into mortgages, but a bank is only as strong as their consumer base. And the weaker the consumer base is financially, the weaker that bank's going to be. And unfortunately, as this consumer base in this country, we're the weakest link in the whole chain. And we're the ones that are failing, so the banks are failing.
So you're saying that if more people did mortgage equity optimization, then they would be in stronger shape, and then the banks would have fewer loan losses because they would have fewer defaults in their mortgages.
Without a doubt. If we would have been doing this decades ago, this housing problem that we've had, this economic debacle we've had, wouldn't even be on the radar. Wouldn't even come close to it.
Okay. Now, when people go to your website, truthandequity.com, what are they going to find about how this whole system works?
Well, the first thing they're going to find is they're going to find that we're requesting that they provide us some basic information into our what we call a personal profile. And that the basic information is what do you owe, what do you spend, and what do you bring home. There's nothing sensitive. But those are the basic numbers we need to be able to determine if you as a homeowner is a good candidate for this program. If you're upside down, equity-wise, that may create an issue. Generally not, but it can. We can actually work around that credit score. But we need to know your personal financial situation so we can make a good recommendation. So that's where we start. Once they complete that, they'll find a summary results page that'll really break down the numbers of what they're doing today and how their life would look financially with our program. And from there, you have access to links, several links to learn a lot more about our program. Plenty of videos to see. There are testimonials. You actually have the option to email and correspond with some of our customers to see how the program has treated them. So there's a lot of information. We just ask that we start with the personal profile, and then we go from there.
When people first hear about this, they may be skeptical, but this would be appropriate for them. Who is this appropriate for, and who is it not appropriate for?
Well, it's not appropriate for sure for somebody that's fiscally irresponsible. We just can't help people that just don't have a grasp and a handle on their finances. That's a deeper problem that we get into. The perfect customer, fiscally responsible, good credit score. They can, equity in their house or not, it doesn't really matter. Just as long as they're financially responsible, they've got positive cash flow at the end of the month and a good credit score, and we can help just about anybody in that regard. But I wanted to finish off real quick, too. Once you go through our process online, your information will be fed into our system, our secure system, and one of our staff will retrieve your personal profile and give you a call or send you an email. So if you do submit a profile, be on the lookout for that phone call or in the email and take the time to talk with one of our staff members. They'll really bring you up to speed on how our program and our system works. Our service works because our system is all about education and helping people, learn something new. It's impossible. You can't become a dentist or a doctor without going to school and learning how to be a doctor or a dentist or anything else for that matter. We're the same way. It's hard to implement a brand new financial strategy without the expertise, the education, and the knowledge to bring you along. So that's what our staff, that's their primary job is to bring you along. So if people do fill out a profile, talk with one of our folks. Answer the phone call, answer their email, and get to know us a little bit.
Very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Bill Westrom. He's the president of truthandequity.com, which helps people implement the mortgage equity optimization program, allowing you to pay your mortgage off many years sooner than you might think possible. We'll be back after this.
Up-to-date business and financial news. Call now and get the financial information you need. 866-472-5790. 866-472-5790. The experts are here. Voice America Business Network.
Go behind the scenes of what you see, hear, and read on the news. Learn the ins and outs of public relations on Stars of PR with Cindy R. every Thursday at 7 a.m. Pacific Time. Cindy Rakowitz is a Clio Award winner and is the co-founder of BR Public Relations, who wants to share her PR experiences and knowledge with you. Learn how to handle a crisis, deal with celebrities, and become a terrific PR executive. Listen to The Stars of PR with Cindy R. every Thursday at 7 a.m. Pacific Time, 10 a.m. Eastern Time on the Voice America Variety Channel.
Technology is changing the way we live our lives and how we do business. On CIO Talk Radio, we talk about the benefits of technology and the great things it allows us to do, as well as its risks. Heard every Wednesday at 9 a.m. Central, 7 a.m. Pacific, Sanjog Gall interviews business leaders and other experts that are shaping the way we use technology. To learn more about the show, visit www.ciotalkradio.com. Keep up with the changing world of technology and listen to CIO Talk Radio with Sanjog Gall. Listen in every Wednesday at 9 a.m. Central, 7 a.m. Pacific, right here on Voice America Business.
Do you want to know what's really going on these days? Well, Capital Thinking takes you inside the worlds of policy, politics, law, and business. What happens in Washington, on Wall Street, and in our nation's legal system impacts your business every day. We're taking you on a behind-the-scenes tour of all of it. Each week, we bring you unfiltered conversation with a variety of influential policymakers, lawyers, and business leaders. I'm Kevin O'Neill, and I'm your host as Capital Thinking tours the halls of power. Join me for Capital Thinking on the Voice America Business Network each Thursday at noon Eastern and 9 a.m. Pacific Time.
From the boardroom to you, Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Bill Westrom. He's the president of truthinequity.com, which is a firm that helps people pay their mortgages off years sooner than they ever thought possible through the strategy called mortgage equity optimization. Welcome back to the show, Bill.
Thank you, George.
So just kind of take us to the basics of how this mortgage equity optimization system works compared to using a traditional mortgage.
Okay. The key to the whole program, equity optimization, like I brought up earlier, from that corporate mentality, is you've got to utilize a revolving line of credit. You need to use a line of credit as your primary financial tool with this strategy, because it gives you the opportunity to get in and out, as opposed to a conventional mortgage. You know, if you threw 100% of your income at a conventional mortgage, Jordan, what would happen at the end of the month when it was time to pay bills?
You couldn't get your money out to pay your bills.
There's nothing left because it's all in somebody else's treasure chest. With the line of credit, with that revolving door, you can go in and get what you need to pay your bills. And up until that point, with your income sitting in the line, pushing the balance down, it's saving you interest. That's offset accounting at its best. Is getting that income, 100% of your income, working against the debt, as opposed to the 6% most people are doing today with a conventional mortgage.
So you can use a home equity line of credit. What other kinds of revolving lines of credit can people use?
Well, there's your home equity line, which is secured by the home. That's why it's called a home equity loan or line of credit, because it is secured by your home. And there's also unsecured personal lines of credit that are given to you just strictly based on your credit worthiness. They're not secured by a home or anything else. So, again, line of credit, if it's got a revolving door, then it can be used for this strategy.
Personal lines of credit, though, in many cases will charge fees to write a check against it or access the line. So that doesn't work too well. Is that right?
No, that's not recommended. You know, and that's what our service is all about, is the expertise and the nuances of running this program at 100% efficiency. Because part of our inefficiency as a consumer base is conventionally how we operate. You know, ATM cards, checks, et cetera, and that's what we attack at Truth and Equity, is breaking the habit of those conventional patterns and working much more efficiently through the line of credit.
Okay, so you're keeping your income in the HELOC. It's pushing down the principal on a regular basis. So what happens each month to the mortgage payment as you keep your money in the HELOC as opposed to a traditional mortgage payment?
Well, your mortgage payment is, in a line of credit, the only payment that they're looking for is the interest that you owe based on the outstanding balance. So your payment is an interest-only payment. Now, if it's based on what you owe, if it's calculated based on what you owe, your average daily balance, and with our income keeping that average daily balance as low as possible, your interest payment actually goes down on a monthly basis, and the difference between last month and this month stays in the line, compounds on a monthly basis, tax-free, and aids in the acceleration process.
So saying every month that goes by, you're actually owing less interest because the principal is going down at an accelerating pace. So the total between the principal you owe and the interest you owe is actually going down each month as you pay the mortgage off faster.
Exactly right.
Compare that to what a traditional mortgage would be.
Well, to be honest with you, with a traditional mortgage within your payment, I mean, the amount of interest that is being paid on a monthly basis goes down. I mean, we all know how a conventional mortgage works. You know, each month you're paying a little less interest and more in principal. So there's some crossover as far as that goes, some similarities. However, in the line of credit, you're utilizing 100% of your income. So your interest savings is actually greater on a monthly basis through the equity optimization strategy in the line of credit than it is with the conventional loan. Because that conventional loan, it's already set. They've already told you for 360 payments or 180, 15 years, this is what it's going to do. This is what it's going to look like. With the equity optimization, there's no standard amortization table. It's not amortized over a time frame. It's all based on what you owe today and through the month, and that's why it can grow much, much faster in the equity optimization strategy than conventionally.
So give us a sense of, if you do the strategy, how many years it will take to pay off a typical 15 versus or 30-year mortgage compared to doing it in the conventional way?
Well, the time frame to pay off, it really depends on an individual's cash flow situation, how much they make and how much they spend, you know, what their total debt load is. But on average, we've seen 7-year and 6-month payoff. Whether it be 15 or 30 years, it really doesn't matter because it's based on income and expenses and debt load more than anything else. But again, on average, our payoff is 7.6 years compared to the 15 or 30 in conventional loans.
So it's about half. And with a 15-year mortgage, you pay it off in 7 years instead of 15. And with a 30, you'll pay it off in, again, 7 years versus 30.
And again, that's about an average number. If we bring it all together, 15 years, probably a little less than that. It drops a little low, below 6 years. And on a 30-year, it's a little bit higher than that. It's actually been moving a little higher over the last 4 years with everything going up cost-wise. So it's moved things out a little bit. But I can tell you one thing. For those people that have been in this for 3 or 4 years and experienced the increase in gas costs, et cetera, their monthly cash flow is still probably 60% better today than it was previous to the debacle and then being in a conventional loan.
So they're getting more cash flow because they're paying off more and more principal every month and their payments going down, and then what's left over is their additional cash flow.
That's part of it, but more importantly than that, they're not locked in to a 30-year payment of $1,200, $1,500, $1,800. You know, that's the biggest problem with conventional loans. You sign the document. You've signed the contract for 360 payments at $1,800 a month. There's nothing you can do to change that. Those people that contract has more control over $1,800 of your income than you do because you signed the contract. This is a big part of our problem as a society. We're all locked into these unbelievable payment plans that we can't get out of and can't get any relief from without refinancing and doing that whole game.
So what's the difference?
Optimization, you're not locked into that $1,800 a month payment.
So what kind of additional flexibility do you have using optimization compared to a conventional loan when you have the same payment every month?
You've got 100% flexibility, authority, and control over every dime that you have because you've got the line of credit. You've got the revolving door. You've got a key to the door. You've got a combination to the vault, and it's your vault. Conventional mortgage, as we all know, they've got the combination, they've got the key, and we don't get access to it.
So if you have extra cash flow during the month, you can put it in there and pay it off faster. If you have less cash flow, you can put it in slower and pay it off a little bit slower. But you're not obligated for the same amount no matter what's going on in your circumstances. Is that what you're saying?
Yep, precisely. And life is fluid. So, we're going to have highs and lows. We're going to have unexpected costs, unexpected things that pop into our lives. For example, I've got a customer that has been on board with us for only 8 months, but 6 weeks after signing on, her husband had to go in and have a quadruple bypass surgery. And we talked afterwards, and she had $10,000 in bills that came through on that situation that she financed out of the line. Now, without us, she would have had to finance it through credit cards at 16, 17, 18%, which would have crushed her monthly cash flow. But with this, it was not even a bump in the road. And granted, it's going to slow down the process, and I'm bringing this story to light just because life is fluid. These kind of things happen. Conventionally, we're not prepared for it. Especially if, all your income's sitting in a 401k or someplace you can't get to it, or based on your financial plans, you're not going to go after, $10,000 in a liquid count someplace because for kids' college or what have you. So you're forced to pay the debt with a credit card, and that just destroys cash flow. So again, with the line of credit availability, the flexibility to go in and get out of it, to use it to your advantage, it's a life changer.
How about even in an extreme case, like you set this up, everything's going fine, and then you lose your job? How can this help you compared to if you were locked into a traditional mortgage?
Well, it kind of goes along the same lines of the story I just told. But, when I get that question a lot, that's probably one of the most common questions. What happens if I lose my job? And my first response to that is another question. What happens to you if you lose your job today? And as we look at somebody's profile, you got $1,800 mortgage payment, maybe a couple of small credit cards and a car payment. Well, you're obligated to pay those. You sign the contracts. So without the flexibility to have a pool of funds to go rely on to support you, we have to look at our homes and our lives as mini corporations. Our home is the building, is our business. Our income is our revenue. We've got fixed expenses. We've got monthly and daily expenses. And so if we lose our job and we've got equity in our home and we've got access to it, I hope to God you've got access to it before you lost your job, because anybody that's got equity that doesn't have a line of credit right now today, whether you need it or not, go get it, because it's better to have it and not need it than to need it and not have it. But if you lose your job, let the home support you until you're back up on your feet. With that line of credit through equity optimization, if you've lost your job after implementing our program and you're only obligated to pay $800 a month in interest to keep them happy, well, that's a lot better than $1,800 that you have to make to keep them happy. And if you need to go access equity in your line, in your home, in your corporation to support you, well, if you spent the last 10 years supporting your home, let it support you for a while. It's better than going bankrupt and losing your home in foreclosure because you weren't prepared for the event.
Very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Bill Westrom. He's the president of truthinequity.com, which is a website that can help you implement the mortgage equity optimization strategy we're talking about. We'll be back after this.
Whether the market's up or down, or if you're looking to improve your portfolio, our experts are ready to talk to you. Call now. Toll free, 866-472-5790. That's 866-472-5790. Voice America Business Network.
Join Patricia Raskin, the host of Positive Living on VoiceAmerica.com, Monday at 11 Pacific. This program brings you practical and inspiring principles for living a more authentic, engaging, and passionate life. Patricia's guests will give you a formula for connecting, giving, forgiving, and miraculous living. So tune in and call to Positive Living, Mondays at 11 Pacific Time, right here on VoiceAmerica.com.
Today's business marketplace is becoming increasingly global thanks to technologies that didn't even exist a few short years ago. Your business might be a startup, or you might be one of the Global 500. Either way, you're probably looking at customers and competitors in faraway regions. Listen for Global Reach with host Tay Rivez as she brings together experts, ideas, and listeners to help you anywhere in the world. Global Reach is broadcast every Thursday at 2 p.m. Eastern Time, 11 a.m. Pacific Time on the Voice America Business Channel. When it comes to business, you'll find the experts here. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Bill Westrom. He's the president of TruthInEquity.com, which is a firm that helps people implement the so-called mortgage equity optimization strategy that allows people to cut their mortgage payment by many years and many, many thousands of dollars. Welcome back to the show, Bill.
Thank you, Jordan.
Let's get a bottom line. Let's compare a traditional 15-year mortgage, where they pay the same payment for 15 years, and what they'd end up in paying interest over those 15 years, compared to a typical mortgage optimization strategy, everything else being the same. How much more quickly could they pay it off, and how much would they save in interest?
Well, when you come to how quickly can they pay it off, that's a very individualized answer. Again, because it's a matter of what do you bring home, what do you spend, and what the total debt load is. So that's kind of an ambiguous number to just come pop off with. But if you want to look at a conventional mortgage, let's say a $200,000 30-year mortgage at 5%. Okay, we can go a little lower, to 4%. Well, let me tell you what. Let's look at 4% real quick and just see what that looks like. At 4%, it gives you on a $200,000 loan, that's basically a $1,500 a month payment. And if you go full term, you're going to end up spending about $143,000 in interest.
On a $200,000 loan. Yeah.
Did I say a 15-year? That's on a 15-year loan.
Okay.
All right. So let me take that back. That interest is not going to be 143. It's going to be about 66.
Yeah, I think the 143 was on the 30-year.
Yep. Yeah. So about $66,000. In an equity equity optimization standpoint, at 4%, raising at 4.5 point per year, you're going to be paid off. Again, this is going to be individualized. So if we go in average numbers, you're going to pay off in about 5 years, 4 months, and you're going to save. You'll spend about $14,000 in interest, and you're going to save maybe a bit more, but you're going to save $30,000 to $40,000 in interest on a 15-year loan.
So you not only paid it off 10 years sooner, but you've saved tens of thousands of dollars in interest.
Tens of thousands of dollars in interest. Now, if you look at the 30-year, now we really look at some numbers. $200,000 on at 4%, you'll spend $144,000 in interest. And through equity optimization, you're going to cut anywhere from $100,000 to $75,000 of interest off that bill, depending on where you sit individually. That's a huge, huge amount of money.
So this is probably why the banks particularly aren't too enthusiastic about people hearing about this, because they'd much rather receive those tens of thousands of dollars of interest than have it go in their pocket than yours.
Yeah. You'd think they're thinking that way, but the banks generally aren't going to collect all that money anyway because they're selling that loan off. You're going to hurt Fannie or Freddie or some investment group more than you're going to hurt that bank. But it still goes against their grain for sure. They don't want to discuss that because it's not in their makeup.
So one of the big objections people have about this is, why haven't I heard about this before? If it's so great, why has my banker told me about this? What is the answer to that?
Well, my usual answer is good question. I wish I knew why most people didn't hear about it, because if we did, our country wouldn't be in this shape. Now, granted, I might be out of business because I wouldn't be the main guy trying to teach the public about this. But again, the poor bankers, they've just been doing the same thing for decades and decades and decades. It's the same reason we're doing what we do, because they're the ones that are teaching us. They're our trusted advisors. And their brains are ingrained in this model, this business model of long-term loans, checking accounts, etc. And I think what this recent debacle has proven is that it's a broken model. It's just a broken model. That's it. And it's not that equity optimization is the end-all, the beat-all for everybody, because it just doesn't fit everybody. However, if you're looking at your personal finances and you're tired, of trudging through wet cement trying to get someplace, then look at an alternative. Look at a program, a strategy that's been tested and proven over the last 5 years, and the pilot program that we've been running, basically. If you want to look at it that way, for the last 5 years, we've got thousands of customers around the country operating this strategy, and their lives have never been the same since they got to know us and started putting this thing together.
What has been their real-life experience compared to what the projections were when they started with the program?
Well, again, that's a very, very individualized answer as well, because everybody, people's lives are fluid. So some people that have stayed right on track for the mortgage acceleration portion, right to the month. We projected 4 years, 5 months. They paid off in 4 years, 5 months. I've got several examples of people that paid off right to what we projected. For those people that have fallen off pace, well, a lot of people they've improved their homes with home improvement projects, so that slowed the acceleration process down, but they've improved the value of their home. I've got families that are funding their kids' college education when the kids are only 5, 6 years old, because through equity optimization, we're showing them that they can utilize their corporate equity, if you will, the value in their home, and get the college funding started today and have college funded before they're even out of junior high school. So, again, it's very individualized for each individual consumer and where they stand in life and what they're trying to accomplish and what's going on. Like the gal that her husband had bypass surgery. Well, her 4 years and 3 months has gone now to 5 years and 7 months.
So even if things slow down, you're still paying it off years sooner than you would otherwise, just not quite as fast.
Oh, yeah, exactly. Like I just said, these are true numbers with this customer. 4 years, 3 months before the husband had bypass surgery. With the $10,000 bill, it's going to 5 years and 7 months.
Yeah. So
it's still cutting off close to 25 years of the mortgage that she had just got before she met us.
The home equity line that you're recommending people use is a variable rate. It's usually tied to the prime rate of today, 3.25%. One thing people ask all the time is, what if interest rates rise from 3% to some higher rate? How does that affect your payoff, and isn't that a scary thing?
Well, rates are going to rise, aren't they, Jordan? They can't get any lower unless the feds are going to start paying us to borrow money. So they are going to go up. And when? How much? Well, my crystal ball is as foggy as everybody else is, and I'm going to rely on Mr. Bernanke saying that they're going to hang in there for 2 years. Well, when they do start rising, it's our belief that the increases will be small at best and incremental, because when they do start raising rates, and if you look at those rates as the accelerator pedal for the economy, meaning that they got their foot to the floor right now, when they start raising rates and pulling their foot off, they can't just jump at a full point. That would just bring us to a screeching halt as far as the economy goes. So it'll probably be an 1/8 of a point increase, and then they're going to have to wait to see how the economy digests that move before they make another one. And the next one could be back down as well as it could be going back up. But the funny thing with equity optimization is that the process focuses on the balance. And the balance is what's needed to with the interest rate, to formulate a new payment. That's why people are so scared of a rate increase, because it means my payment's going to go up. Well, that's only if the balance remains the same. If you can attack the balance, then you're almost always immune to rate, because the payment's going to be based on the interest rate, and if you can move that balance down faster than the rate can go up, then you're rate immune. You never have to fear it. And when our projections, I think I mentioned earlier, in our projections at Truth and Equity, we use a 0.5% increase per year for the life of the loan to see how each individual could weather the rate increases. And through
so
that
you're kind of
analysis,
giving them a worst-case scenario and showing how it would work out in that case.
Yeah, exactly. We can make it look as ugly and as pretty as we want to within realistic numbers and realistic expectations. And a lot of times that will dictate that, maybe you aren't a good candidate for this right now based on your particular situation because you can't keep up with the rate environment.
Yeah. So, okay, so you're in the situation where even if rates go up again, you're still paying off the principal at a faster pace. So it doesn't really affect you that much. Okay. So the other thing people ask is, well, it sounds like a pretty simple strategy to use this revolving line of credit to pay my bills and so on. What could go wrong, or what's complicated about this? Why do I need somebody from Truth and Equity to kind of take me through the process and customize it for me?
Well, once you get going, it's not complicated because you're running your life very similar to the way you do it today. But the caveats are, one, the lending environment. All HELOCs are not created equal. There's different rate scenarios, fee structures, draw periods, etc. And if you get the wrong one, then you're not going to be able to operate the strategy efficiently, and you could put yourself in trouble. And it's our expertise of the marketplace out there, who's offering what, who to work with, who to stay away from. So it's our expertise in that regard to help lead consumers down the right path to get the right loan for the program. Second of all, it's a change of habit. We've got to change our conventional processes of how we pay bills and write checks and use ATM cards, etc. Well, we've got to break those habits, because it's those habits within this environment that will keep it from running efficiently. Because we want 100% of our income working for us 100% of the time. And again, that's our expertise. That's where the rubber really meets the road with us, is our coaching, mentoring, and our one-on-one service to teach you exactly what you need to do, when to do it, and how to do it. And we monitor your activity on a monthly basis to make sure you're doing things right. And if you're not, we'll see where the weaknesses are, and we'll make adjustments, and you'll make adjustments. And we'll continue to do that until you are operating at peak efficiency throughout the life of the program.
So you have an individual account on the truthandequity.com website where you can be monitoring things, and as things change, as your income changes, as your expenses change, you can be changing that, and it'll see how it affects the payoff. Is that the way it works?
Yes, exactly. So every month you'll have the opportunity to go in and input your numbers, and it'll just keep a running tally on where you sit. If we started at 4 years and 5 months, and now you're at 5 years and 6 months, well, we'll take a look and see if that was an operational problem or what's going on, and make those corrections. Or you'll be able to see you started at 4 years, 5 months, now you're at 3 years and 8 months. Fantastic. You're running beautifully. You're ahead of projections, and keep on going. But you have unfettered access to that month in and month out.
Whereas if you did this on your own, you wouldn't have a good sense of where things stand, is what you're saying.
You don't have any way to find out. You're just going to be flying blind and flying by the seat of your pants. You won't know if you're doing things right, wrong, or indifferent, because you won't have any tools to fall back on, and you don't have any professional guidance.
Indeed. Okay, very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Bill Westrom. He's the president of truthinequity.com, which is a website that helps people implement the mortgage equity optimization strategy, which helps people pay their mortgages off, as you've been hearing, 10, maybe years sooner than that, and save tens of thousands of dollars off of what they need to be paying with their mortgage. We'll be back with Bill after this.
Still there?
Yeah, he should be telling us there's a break.
Whether the market's up or down, or if you're looking to improve your portfolio, our experts are ready to talk to you. Call now toll free 866-472-5790. That's 866-472-5790. Voice America Business Network.
If you think you've seen online TV before, let us surprise you.
VoiceAmerica.tv is online now.
The leader in live internet talk radio has done it again. Multiple channels, a state-of-the-art viewing experience, live and on-demand programs streaming 24 hours a day. It's exactly what you want, when you want it.
VoiceAmerica.tv.
From health and wellness to business, sports, and everything in between. Discover our new world. Visit VoiceAmerica.tv now and experience the future of online television.
VoiceAmerica.tv.
It's all Arizona, all over the world. If you're a local Arizona high school sports fan, or if you're a transplanted fan somewhere else in the world, have we got a show for you. The first internet sports radio talk show focusing solely on high school sports is The Coach's Corner with Scott Lovely. Tune in to talk about your favorite teams, players, or coaches. It's 100% Arizona high school sports coverage and a little bit more. Tune in Mondays at 4 p.m. Pacific Time, 7 p.m. Eastern to the Voice America Sports Channel.
When it comes to business, you'll find the experts here. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Bill Westrom. He's the president of truthinequity.com, which is a website helping people implement the mortgage equity optimization strategy. Welcome back to the show, Bill.
Thank you, Jordan.
You were talking about the people that somebody who signs up for the service is dealing with, the financial strategists. Tell us a little bit about them and what kind of training do they have, and how do they help people implement the strategy in a way that would be hard for them to do on their own.
All right. Well, our financial strategists, they're experts in the implementation and execution of the strategy. They go through a rigorous training program, several weeks long, understanding how our system works, more importantly, understanding the consumer and how to analyze their personal information and finding how equity optimization can be utilized in their particular situation and optimized, if you will, so they're getting the most out of every dime that they earn. And so they're really the best in the country. There's few people out there that know as much as they do. And once a consumer or homeowner gets involved with them, they're going to find it's an experience that they just don't find with other companies, because our people take it very, very personally, because we're talking about lives that you've spent a lifetime trying to build, and we take that very seriously. And so it's a very hands-on, one-on-one process, and each program is custom-tailored, custom-fit to the homeowner and their particular situation. So our staff, like I said, I'm very, very proud of these people. They're the reason that we're still here and why our customers achieve so well, and why we have a 98% retention rate with our customers.
Now, there are other players in this field of mortgage optimization. How is what Truth and Equity do is different than the other players out there, including some that have done this as a kind of multi-level marketing scheme? How is what you do different from them?
The biggest difference is our one-on-one personalized service, because we don't sell books, we don't sell loans, we don't sell software. We're experts in this strategy, and we focus 100% of our efforts on implementation and execution. Some of our competitors out there, whether they're, like you said, I think, UFirst Financial is a multi-level marketing operation. They're in the business of recruitment and selling software. And if you sign on, no matter what your background or who you are, you're an agent, you're in. So that's a huge difference between us and them. And there's another a couple other companies that offer, they actually offer specialty loans that can operate, where you can operate this strategy. But again, you don't get any personalized service. They're in the loan business, and they're very expensive, and there's heavy restrictions on who they will loan to and who they won't. So with them, they're very tunnel vision on what they do and what they offer. With us, we can work with the whole financial market out there, in any small town, any big city, and we take that personalized approach up front to make sure you're a good candidate. We don't recommend anybody implement this program if we can see, based on the numbers, this isn't for you, at least not right now. We don't have any problem walking away from a potential customer if it's not right for them. So that's pretty much the biggest difference, is our personalized service and our expertise in the implementation and execution.
What are the kind of institutions that people typically are getting HELOCs at these days? Is it traditional banks? Is it savings and loans? Is it credit unions? Where are people getting good deals these days?
It's traditional banks. It's small community banks. It's credit unions. It's some of the larger banks in the country. They're just, again, it's just a matter of finding the right type of HELOC that's got all the correct operating components. And that's where a lot of self-implementers, if you will, have failed, because they just don't understand the lending process, and they don't understand exactly what they're getting in relation to operating the program. So a lot of people have borrowed their way into a corner, and it's been a hat trick on a few occasions to get them back out of that situation. So you got to know where you're going and who you're talking to before you go signing documents.
Now, back in the financial crisis in 2008, 2009, banks were pulling back severely. In fact, in some cases, froze HELOC and other credit lines. How can you help people if that were to happen? Do you think that might ever happen again?
Well, it might happen again. Thank God we haven't seen it in, for us personally, and our customers and where we've been sending our customers, we haven't seen a line frozen in 3.5 years. So, which, knock on wood. But I think a lot of that's happening is because the housing market is stabilizing. It's stable off. It's not falling like it was. Can it happen again? Sure can. If we double dip, as they say, and values drop, then there's a potential of line freezing. If that does happen, what do we do? There's lots of options. But again, that's why our personalized service is the way it is that if it does happen, you've got somebody to come talk to. You've got somebody to fall back on and say, okay, now what do I do? Who do I go talk to? What do I do? What should I do to keep the program running? So if it does happen, you're by yourself, good luck to you. If you're with Truth and Equity, you give us a call, and we're going to put a new plan into action.
Yeah, a lot of people are really freaked out when that happens, because you've got all your money in the line, and all of a sudden it's frozen.
Yep. But there's remedies, and there's ways you can move to get out of that situation and maintain the process.
There's a lot of people today who are kind of frozen, and they think Washington should kind of save us from all of our problems, get some compromise there. You think people shouldn't really wait for Washington? How does your strategy allow people to act now, no matter what's going on in Washington?
Well, our strategy allows people to act now if they're ready to act. There's a lot of talk about the lack of leadership in this country. And we're all looking at Washington. We've got an election coming up. But we need to wake up. We've been doing this a long time. We know these people cannot lead us individually. Okay, as a country, we're keeping an eye on things, and we're all pretty much petrified of what's going to happen down the road. But if you want to lead your family financially, you lead your family. Don't wait for Washington. Don't wait for the banks. Nobody's going to save you and teach you how to be better. They're either going to legislate more into your life, or they're just going to tell you the same old stuff. Make more and spend less. Well, as things start increasing in price, we can't spend any less. I'm not getting any more raises. What else am I supposed to do? Well, what you should be doing is looking at alternative financial practices that are more efficient, that will help you get more out of your money. You've got to take things into your own hands. Don't wait for Washington. Don't wait for the banks to offer some newfangled gizmo or gadget to help you figure out what your balance is. You have to take things into your own hands right now Evaluate what's going on right now with your current situation. Pull back the layers, pull back the curtain, and see what's holding you back from achieving your financial goals or what's making it tough on you on a monthly basis. And I can pretty much guarantee the reason people are having a tough time, long-term mortgages, amortized cars, student loans, and having your money sit in a bank account all month long doing nothing for you. That's what needs to stop. And if you want to lead your family financially, you better pick up the ball and do it on your own and don't wait for Washington or the banks because they're not going to help you.
Very good. My guest has been Bill Westrom. He's the president of truthandequity.com, which is a website you can go to for free to see how this might help you pay off your mortgage much faster and save you tens of thousands of dollars with the whole system of mortgage equity optimization we discussed this hour. Thanks so much for being a guest on the Money Answer Show, Bill.
Hey, thank you, Jordan.
Thanks so much, and we'll be back with another edition of the Money Answer Show next week. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time, right here on Voice America Business. See you next week.
What do you think of the